Good morning, traders. Today is July 30th. Let's get started with the update this week. The major markets have not changed direction overall, even though we saw a pretty strong rally in the U.S. Indexes and certain stocks last week. The long-term rotational modeling system has not changed direction really at all. We're still bearish on the Nasdaq, bearish for gold, bearish for silver. Remember, this is long-term, so this is not moving upward yet because of the downward trend for gold and silver. Even though gold and silver had a nice pop, same thing with the Nasdaq this week. Longer term and shorter term, we're not seeing the rotational modeling system change direction. The detailed charts I show you in a bit will really highlight what's going on in the markets right now. Oil is mixed, a long-term bullish, short-term bearish. In fact, all the other indexes, the ES, the YM, the Indu, the Dow Jones Industrial, Transportation, and SPY are mixed, long-term bullish, short-term bearish. Now, the overall market position that we have is moderately strong long-term trending and very bearish short-term trending overall for the major indexes. And this is because, again, the Nasdaq has moved lower. The dailies have moved into bearish trending on all the ES, NQ, YM, and SPY. Stocks are at a 10% allocation. Cash is at 45%. Metals that are at 25%, which are really starting to show some life right now, and bonds are at 20%. Overall, remember, the allocation level moved from, actually, I'll rephrase that. We started exiting out of our long positions based on the rotational modeling system and my proprietary indexes back in August and September of 2021. I started warning in early 2021 that the markets were weakening and to start protecting with a trailing stop. And then in August and September, I started warning everyone to potentially get out. The long term was that we needed to be very cautious of a downward trend. The Fed was already positioning to move higher, and we started to see some real weakening in the markets based on my indexes, particularly the smart cash index and the volatility index. So right now we've done very, very well. We moved out of the markets before they topped, which got us into a nice cash position. At one point we were up at 65, 75% cash, which did very, very well. We had moved our position down to 25% stocks and then down to 10% stocks. So we're playing very little in the stock market right now, if you follow my research, or you should be. We're holding our metals position because this fallout in metals is still holding up quite well overall, and metals have really, if you look at them historically, have performed extremely well. And bonds, we were holding bonds for a while, got out of them, and then got back in with an extra 10% just a few weeks ago. Bonds are starting to come to life as the U.S. dollar and the U.S. market seems to be immune from global risks at the moment. Right now, this is my interpretation, my summary. The rally in the U.S. markets may be nearing a peak. My indicators are suggesting the markets are struggling to build momentum behind this rally. A breakdown may happen suddenly if you are not prepared. Gold finally bottomed and bonds are starting to show life again. The Fed is still trapped and will continue to raise rates as metrics show strong inflation. Hold tight as we let things settle. And really, that's the overall trend here, ladies and gentlemen. We're basically in a transitionary phase, a downward trend in the markets, particularly global markets and emerging markets are at risk. I strongly feel, as I mentioned a couple weeks ago, that currencies are the next big issue. The stronger U.S. dollar, the stronger U.S. economy could push currencies and emerging markets into a very serious contagion type of event where dominoes start to fall. And let me explain this. We had a scenario in the late 1990s that's very similar to right now. We had the rise of the technology sector with the internet and the dot-com bubble. We had a fairly strong housing market in the 1990s after the 1993-94 stall. We had rising CPI throughout that entire time frame, through the mid-90s all the way through 2007 and 8. We had a moderately strong inflationary period, nothing serious, but we continued to see fairly strong inflation throughout the 1997 through 2000, call it 6 or 7 peak. And the Fed was aggressively raising rates throughout these periods. until we had the 9/11 attack, and then until we had the global financial crisis, 2007, 8, 9. So we're in a very interesting period where the U.S. markets could continue to actually show some strength and or trade a bit sideways here, while CPI is still strengthening and the Fed is trying to fight inflation. This means that bonds, in my opinion, and gold, which remember, gold started to perform very, very well at this point and eventually rallied extremely high. But we're in a very early stage basing, bottoming formation in the U.S. markets right now, which may take many, many months to actually form a bottom. I think we're due for one final low, as I've mentioned to you, and we'll show you the 3,400 or lower area on the S&P is a really a good bottoming basing area, which is why I'm warning everyone to be cautious right now. I think we're due for another downward move, but we're in a great position to be able to try to buy into the next wave 5 rally. And the wave 5 rally that I've been projecting may come in the form of a fairly strong move, a global market contagion where cash rolls into U.S. bonds, U.S. equities, and metals. We could see this happen as currencies and economies start to contract. And remember, it may not be a sudden event. It may be just, 3 to 5 years of contractionary event where emerging markets and at-risk nations go through credit defaults or other issues, consumers tighten, central banks try to raise interest rates. It could be that we just go through a period of 3 to 5 years of contractionary economic activity, which could, like I said, send a lot of capital rushing into the strongest economies on the planet, which would again be the U.S. market and potentially Europe. Japan right now is weakening. In fact, I'll try to get some data here loaded to show you. So again, we're holding up very well. We're very well protected. Our cash position has gone up 12 to 14%. We've been protected against stocks essentially since the last 12 or 13 months. If you followed my research, we got out of stocks very early, near the top, actually before the peak in the market, which you should be celebrating that while everybody else is sitting at a minus 24, 25% loss. And our metals position is holding up okay. It looks like it's actually formed a bottom, and bonds are actually starting to hold up. Our alternate position is 75% cash, 10% stocks, 15% bonds. So let's take a look at the custom indexes. The FANGs index formed a nice little base here. You can see we found support in this upper channel here. We're still below this 50% retracement area. This is from the COVID low to the post-COVID high. If we stall below this level here and roll back downward, I still think we're looking at a low back down in this area, which would essentially be the 130 to 120 area now. We need to see this flush out low. You can see RSI is still lower, stochastic still lower, getting a little pop, and you can see in an uptrend here how we get these little pops and then roll, pop and roll. We could get the same thing here, pop and then a roll, pop and a roll, pop and a roll, and see it move lower. So be cautious. If you're in these technology stocks thinking that this is a real solid bottom right now, you want to try to find a decent stop level to protect against a downside move, and be cautious. Remember, we should be trading smaller positions right now, not getting overly aggressive. The U.S. stock market index had a nice little pop here. It's above this red line, which is these late 2020, which is the election time. Actually, the election time frame was here, but understand that we're above this support level, which I think is fairly critical. We may be overextended to the upside right now with the Fed recently raising rates, so be cautious. We've got a little pop here, a little pop here. Still in bearish trending with regards to RSI. This could extend a little bit higher as foreign capital moves into the U.S. stock market, but we've had this move, this really solid downward move, back up, another solid downward move, back up. It looks like a mirror pattern almost as far as price range, and I think we're probably going to stall out and attempt to move a bit lower, back down into this lower level here. I think we're really going to find support down in this area, ultimately maybe down in this area if we get some sort of a washout low. And this would depend on real, if we get a serious contagion event or just a mild series of emerging market events or moderate contractions. So if we get a serious event, we could see the entire world react to it. If we get a series of moderate contractions going into the end of this year in the U.S., I expect the consumers to continue tightening, housing market to weaken severely, more foreclosures, more delinquencies. Consumers are pretty well tapped right now, at least as far as the data that I'm seeing. Credit card debt is extremely high, and delinquencies will start to show up. So remember, the stock market is a different beast, and remember, we just hit 2 quarters of negative GDP, and the Fed just raised interest rates. So this is very likely just a little buy the dip bounce right here, ladies and gentlemen, and nothing serious. Okay, next, the smart cash index is moving lower. Very muted bar over here. The current bar is very, very tiny. And we saw like right over here, very tiny bar right here. Another very tiny bar here. A number of very tiny bars here. One way up here. We could very well be looking at the end of a little bounce here in the global markets, and we could see a broad decline. Now, global market decline will send capital into the U.S. markets and safe havens, which will be gold and silver, potentially Bitcoin. But long and short of it, ladies and gentlemen, the global markets, the smart cash index, which is mostly global markets, is really showing no substantial momentum. So we are not seeing any real momentum to the upside. You can see RSI is weaker, stochastics is weaker. We're seeing no momentum to the upside, which is why this rally in the U.S. markets might be just really a speculative buy the dip phase. The metals index formed a beautiful bottom off this support level, which I'd been warning for many weeks about. Really expected it to show support back over here and hold as fear came into the market, but it took this washout low, which surprised everybody, including me. I'm still holding my positions. I'm still loving them. I've got a bunch of call options, and I've got a bunch of miners and metal stocks that I'm just letting ride, because I know the long term is that fear is going to drive metals quite a bit higher. This is set up just like, as I mentioned to you earlier, 1996 through 2007. And if you take a look at a gold chart, which I'll show you here in a bit, 1996 to 2007 was a tremendous move for gold. So we're very early in this gold move right now. You look at this and you say, well, look at this move. This is fairly late. No, in my opinion, we're very early at this point, I would say we're pretty close to like 1999, 2000, maybe 2001, with this washout low setting up here. And I'll show this to you on a chart, meaning that we have another 7 to 10 years of continued upward bullish activity in gold and silver. The Valuations Index has moved a little bit higher last week. This is kind of nice to see, and it supports this speculative bounce. You can see throughout this peaking pattern, we've had these bounces, and we've really contracted down into this lower level. I expect this to really stall out. I don't expect it to go much higher. I would suggest you really consider, if you're long a bunch of stocks, protecting them with a stop and or pulling some profits off. Now is not the time to get into a very heavy long position yet. We're in a continued downtrend. Nothing has really indicated that we've found a bottom yet. The Fed is still battling inflation, and like I said, the global markets and emerging markets are really going to be, I think, quite ugly over the next 3 years. So be prepared. You're seeing a nice little speculative bounce, but I don't think it's much more than that. Commodity gold index is weakening. This is because of the strength in gold, the strength in the US dollar. So you're seeing commodities really unwind and kind of flatten out. We need to get back down into this red area. This would be a good washout area for the market. So another downward move is likely, but we'll see how this plays out. The strength of the dollar and the strength of precious metals are really going to be an indication that global traders are fearful and moving assets into the U.S. market and precious metals as fear elevates. The volatility index has moved higher. 10.29 is a pretty good number. Typically, I would consider this a bullish trend if we were in an uptrend. which we are not. We had a new low here. This could be a washout low. We need to see some rotation back to the downside and then a pushing a bit higher. And that would, getting above this, obviously, this pink line here would be a good indication as well. We haven't gotten there yet. So we've had some bullish activity, a little hook in stochastics. This is moderately bullish right now. I mean, I can tell you that this number represents moderate bullish activity, but we have not seen any upward trending and expanding wedge formation. It may come, but we don't have it yet. So we don't have any real indication that we've seen a washout low. We would have been down below this 6 level on a very strong washout low, and we're not yet breaking through this upper channel, which is why I'm calling this a very muted, non-momentum based rally right now. Okay, that's it for here. This is my wave 5 projection, which is actually now, as I have updated this, a wave 4. We've pulled back and now we're waiting for wave 5. Let me come back here and go to the other custom indexes, which are these. The volume ratio index was rather muted last week. We had this big buying 3 weeks ago, and that was, as I mentioned to you, one of the strongest buy the dip opportunities that we had seen in many, many years. Remember, this is going back to 2018, and this was a very strong buy the dip activity. Now we're seeing very muted activity back down here. And like I said, I believe that the buying power is starting to really weaken. So pay attention as we move forward. The Bradley Custom U.S. valuation trend was strong upward. You can see we're below this low level here at 0.618. We need to see some sort of a rotation. You can see the peak here in 2020. This rolled down. We're still rolling lower. This is a pretty good buy the dip here. Remember, this was our 2020 time frame, COVID, and this was really the momentum trend. Even though the markets moved lower, this was our momentum higher through COVID. And now we're seeing this unwinding. So we're actually back below the 2019 levels as far as highs. And what we're going to see here is see if this stalls out and rotates lower. And it could very well rotate lower as global markets weaken. See, we had a nice little pop here in RSI and stochastics, but we're still general downward trending right now. So at this point, we've got kind of an A, B, C pattern. We've cleared this high, which is 1, but we would actually need to come way up over here to clear this high to see any real upward trending based on Fibonacci price theory. So I'm going to tell you that I'm very, very cautious right now of this trend weakening and attempting to move lower. I think that there's a lot of money moving into the U.S. markets, but I think it's just a buy the dip mode. The large cap index is, as you can see, flat and moving downward. So the large cap buying is not taking place very well. I think traders are just basically speculating that we're going to get a pretty good bounce, and I think they'll be out of the markets as quickly as they tried to get into it recently. This is a monthly chart going all the way back to 2011. We're in a depreciationary cycle phase. You can see we had this little bounce. Okay, this is solid. It moved up. It's a bit overbought right now. Longer term RSI is very weak. Be cautious, ladies and gentlemen. So here's 2021, the peak. We rolled sideways. This would be an A, B, C move. C being larger. This potentially would be a D move. And now we may be looking at an E. Final wave to the downside. The TT scanner I will get to. Actually, let's go over it real quick. You can see there's nothing new. A couple of flat triggers. Semiconductors went flat. RWX, which is the real estate fund, went flat. And XLB, which is materials, went flat. We're still holding long with the energy and the gas production. Got a couple of new triggers here. This one is aerospace, XAR, and defense fund. We have the GDX, Nugget, and miners. These are weekly, remember. So these have been 3 weeks in. We've got 27% profit. 5% profit, 11% profit, 4.4% profit. Haven't hit any targets yet. Metals are really bottoming, so this will probably get flat fairly soon. If you took these trades, go ahead and try to pull some profits here as we see what happens. But we've got no new triggers. Like I said, markets are really rotating. Metals are rotating. Miners are rotating. We're seeing these flat triggers come in. Semiconductors are going flat. I think we're kind of near a short-term peak, which could become very volatile over the next couple of weeks. The global index, this is the U.S. market versus global market. You can see the U.S. market rallied here. The global smart cash index failed. You can see we have this divergence, which gives us this nice little rally here. Now we're seeing essentially some upward convergence. Let me actually take a look here. Actually, no, we're getting divergence. So we've got a higher stochastics or RSI here from this low to this, or this high to this high. And then we've got a lower highs here across these two. If we stall out early next week, this is going to be a divergent RSI. This could prompt a very strong downtrend. Watch for the global markets to weaken. And like I said, I think the U.S. market, as I told you, needs to get below this 2019 high, 2020 high. I think that's where we're going to see this real washout bottom set up. The global asset index is stalling. I know that you've got a lot of data here, but it's stalled out at 65. It's been near this level for many, many weeks. We're not seeing real asset appreciation. We do have a hookup in stochastics and RSI down here, overbought at this point on stochastics, but we're really just trading sideways and very near this lower range. So we need to see how this plays out and wait for the next downward trend. Okay, that is, I think, the end. Nope. So let's go to the gold cycle index. Was weaker this is a monthly chart, was weaker at the end of July. Gold has been down quite a bit, as you saw, retesting the lows. On this cycle chart, it's very, very solid. You can see we have this lower range where we tend to try to build a base and move forward, build a base and move forward. We've gotten up above it, came right back down into this lower range. We're now building a base. We've rebounded off of that quadruple bottom, and I'm looking forward to seeing gold and silver really rally. I'm looking for gold above really 1925 and silver above, let's call it 23. That would be a very solid rally attempt in my opinion, and I think we would see a very strong move in the markets because that would show that fear is elevating and precious metals are becoming strong safe havens. And I'll show you that as we go forward. Real estate updated as of today, actually last week, I think it was the 22nd is when it was updated of July. You can see that the price reductions are decreasing a bit, still elevated. We are looking at about a 91% of all real estate on the U.S. market is being reduced. Days on active count listing is getting higher and higher. We're already at all-time highs over the lifetime of this chart, which is about 7 or 5 years, but we're going to push higher. And ladies and gentlemen, rates just went up, mortgages went up. People are going to try to get out of their houses while they can and wait it out. Prices are still staying elevated, but we're going to start to see that change, I think, as interest rates mortgage rates breach the 6% level. And as you can see here, this is days on market has gone flat to 0. So we've gone through this entire buying spree, which pretty much everybody was buying whatever they could. Now we've gone back to pretty much neutral days on market. I think this is going to continue to elevate higher. Price reduction shares is elevating higher. That means we're getting more and more on a year-over-year price reduction count. We're at the highest price reduction count ever over the last 5 years, and it's going to continue to stay higher. I think you're going to see price reductions really start to kick in because interest rates are now, for mortgages, for homes in the U.S., are now 3 times what they were just 6 months ago. And that is a big difference between 2.3 and 2.5% and say 6.25 or 6.5. That is a huge difference. That $600,000 house would have cost you about $1,800 a month in mortgage. Now it's going to cost you about $2,700 a month in mortgage. So good luck. House prices have to come down at this point because mortgage rates are going to go higher. The Fed will likely continue to raise rates next month as well, trying to battle inflation. The consumer engagement index rebounded here. This is really, I think, centered more around the holidays, 4th of July and the summertime. We're still very, very low. You can see we're back into 2011, 12, 13 levels. I think this is going to kind of wean out and flatten. You can see we're still very bearish. A little bit of a hook here. It looks like a big move here, but ladies and gentlemen, this could flatten out and end fairly quickly as we start moving into the holidays and consumers start tightening their belt. Gas is come down out here in California to about 540, 550. But again, everywhere we're seeing consumers tighten. I think this was a buy the dip move, a holiday move through July, and we may see it continue a little bit into August, but then we start moving into the fall season, and we'll see how consumers hold up through the end of the year. The technology ratio index is really stalled, and this is where I'm telling you technology, even though we saw a little bit of a bounce last week, last few weeks on this buy the dip, you can see here that we're not seeing any real strength in this technology ratio. In fact, it is flatlining down here to the downside. So be cautious. If you're buying technology and you're trying to bet on a bounce, an extended bounce, I'm not seeing any real momentum yet in this move. Yes, we do have some support down here near these 2014-15 levels, but I am not seeing any real strength. The price is moving up. Speculators are buying the dip, but we are not seeing any big momentum yet. Okay. Oh, this is an old chart. Let's see. This is from March, I believe, 2022. And kind of interesting to see where we're at with this, because I projected a downward move and then consolidating around the 380, 400, then a further downside move. And if we come back over to here and take a look at the SPY, I know it's a little cruded up with my charts. So we can see here, this is weekly, and if we take a look here, we got down to 362, back up to 411 where we're at right now. And oddly enough, take a look at this chart. We got down to 360, back up around 400, 390, and a stall, and then potentially breaking downward. So look at this real quickly. From the peaks from March of this year, 2022, this was March 6th, I created this chart. I predicted that it would go down, stall around 360, right around these levels, then move back up to around 390, maybe 400, and then stall back out. And look at where we're at with this. Let me try to spread this out. You can see I'm going to draw this so you can see it. Get rid of this and come back up here. So from March, right in here, I predicted it would go down to 360, right in that area, and then back up to about 400, right in that area, and then back down into much lower levels. So how did I do? Not bad overall, huh? The low this season, or this section, was over here at about 363. The high right now is 411, 412. Overall, ladies and gentlemen, this is playing out almost exactly as I drew. And understand that we are, if I do the math here, 2021, kind of hard to tell, but this would put us right around August, September. So yep, we're right in that time frame. At this point, ladies and gentlemen, we're right in that time frame for a rollover and a much deeper low. Okay, let's see here. We've gone through, you've seen these charts every week, and I'm going to do an update on this, the S&P and the Nasdaq. Let's go take a look over here at the TT Charger and the Auto Trend Master, because I want you to see how this is rotated. We're still overall, this is the ES, the S&P. Overall, we're in a bearish trend. You can see these red diamonds. That means we're in a longer term. This is a weekly chart, bearish trend. You can see the Auto Trend Master has turned green here with this trigger here. We confirmed it with a close above this trigger. So we're technically short-term bullish on a bounce in a longer-term bearish trend. Same type of setup over here on the Nasdaq. You can see that we had a bullish trigger here on the Auto Trend Master, confirmed it with this weekly bar here. We had another trigger on this last week, which confirmed it here. You can see this downward channel, which I've drawn, which is really more of a price projection, but we're still long-term bearish, short-term bounce in trend. And you can see we've had these short-term bounces. This was a bullish trigger back here, but it never confirmed off this blue line right over here. So let's take a look at the SPY weekly as well. Okay, I have some lines on here. I'll get rid of this line and come back over here. You can see we are long-term bearish, short-term bullish, confirmed off of this line right here, this blue line right here. And you can see we're up near this area, which is the previous high area. If we fail below this previous high, this would be a very critical Fibonacci price reversal based on price theory, and we would start to look for a new downward trend. Let's take a look at the transportation index. We are seeing the same thing, bearish long-term, still bearish short-term. No trigger in the transportation index, which is very important because we're not seeing any real strength in the transportation index for an economic recovery. Let's take a look at the financial sector. We are bearish long-term off the TT Charger modeling system and bearish short-term. We are not seeing any big downward trending or upward trending opportunity here. The next trigger level on the financial sector is down here at 3056, this red line on the Auto Trend Master. Let's come down over here and take a look at bonds. And you can see here, remember this is weekly, so we're not seeing any big strength here in bonds yet. We're still long-term bearish. We have a support or resistance level down here at 108.25. We are seeing support. We would have to get above this blue line level here, 119.78, to see some potential upward trending off of this Auto Trend Master trigger. Let's come over here and take a look at gold weekly. Obviously is going to be in a downtrend because we had this big bottoming basing setup. But let's see if we have any new upward triggers. Nope. We have no upward triggers yet. We had a good solid bullish move here, so we might get a bullish trigger. Let's take a look at silver. Got a line on this chart as well. Get rid of it. Silver is bearish as well. No new upward trigger. Let's take a look at crude oil. Crude oil is bullish long-term off of these blue lines. It's gone into neutral market breadth, and it is bearish on the Auto Trend Master. Now you can see here it got bearish over here. The way Auto Trend Master works is it identifies bearish triggers and draws a price trigger line. So we would need to get below this price trigger line in order to confirm it. Well, on this one, this trigger line here, we got below it right over here, but there were two other trigger lines right here that confirmed on this weekly bar. So we're technically in a bearish short-term trend while holding bullish long-term trend in place with neutral market breadth. That's telling us we're moving into a sideways contractionary phase in oil. Short-term, we're bearish. Longer-term, we're still bullish. Let's take a look at just daily real quick. Daily, we went bearish on June 22nd, and you can see here we've had these rotations. We need to get below this 94.25 on oil for a new downward trigger. Gold, let's take a look and see if we've got any new upward trending in gold. We do off this Auto Trend Master trigger that confirmed last week. On Friday, we're still long-term bearish, short-term bullish, brand new trigger. Silver's probably going to do the same thing. Yep, we have a confirmed trigger short term on silver, long term bearish, short term bullish. Let's take a look at the financial sector. We have moved into neutral trending. Let me see if we have any stops. We do not. So we are bullish on the financial sector short term off of Auto Trend Master, long term bearish, moved into neutral market breadth. And this is telling us that we could be seeing a trend reversal here. IWM, the Russell, is bullish on short term. You can see here we've gone bullish short term and long term. So here we had the Auto Trend Master turn bullish. We needed to get above this price level here. We did on this day on July 19th. We also went bullish on the longer term TT Charger model. So you can see we are bullish on the financial sector here. Russell 2000. And we are pushing higher, which is nice to see. We'll see how this holds up. This could be an early warning sign that the Russell, the small caps, are starting to see some real strength. So we'll pay attention to this. Let me come down over here to bonds. Bonds are bullish off of the TT Charger system. That's what these blue levels show. And it is bullish off of the Auto Trend Master. So we're starting to see some strength in bonds on the daily basis. Weekly basis, it's still longer term, it's still negative. So we're catching a good potential bottom here, even though we're seeing some sideways activity. We've started to turn a little bit of bullish market breadth right here. That's what these green ranges show. Take a look at silver miners and gold miners. Okay, still bearish off of daily on the TT Charger, bullish off of the daily Auto Trend Master. These are very early warning signals in a sense that these are fairly short term. They could reverse, but still a good sign. This is a very good sign here. We need to see it change to the upside. Let's look at the junior gold miners. And same type of setup. We gone into a fairly neutral trend here. That's what these blues show. And then we just went bullish with confirmation here. We're still bearish long term off of TT Charger. But this is a very solid rotation. And like I showed you with the other charts, we're seeing a very solid basing and bottoming in gold. Let's take a look at UUP, which is the dollar. Very strongly bullish. Had gotten a bearish trigger here with the Auto Trend Master and confirmed it just last week. We'll see how this plays out. We've seen these types of contractions come back, so we could see the dollar move downward a bit. But longer term, we still have this this longer term upward support, and we have support at 27.74 and 27.40 right here. Let's take a look at this on weekly. Yeah, you can see it's still very strong on the weekly basis. And I believe the foreign capital is going to continue to pour into the US dollar until this thing breaks. We could see the dollar. Oh, I promised you this. Let me take a look at, where am I going to do this? Well, let's take a look here at gold. And I wanted to show you gold in 1999. So we will condense this and go all the way back to 1999. Now this shows cycle charts here. So what we're seeing here in gold is really this peak. So if you take a look at the 1987 peak, and then you see this contraction and came all the way back down and bottom. Well, this is kind of where we're at right now with gold. We've seen this rally off, and understand that this is really very similar to the COVID type rally. But if you look at where we're at, this is the contraction that took place. So if we take a look at gold, you're going to see a rally in 2000. 15 roughly, and then a basing stalling pattern, and then another rally phase up to here. In this case, it moved in even higher, which we did through COVID and recently. Then we had this extended stalling pattern, and then we started to move higher, and that move through 2005, 6, 7, 8, 9, 10, 11 was really, really excessive. Now understand that that's the peak, and this is the time frame that I want you to be aware of, basically from here to here. So what we've had in gold right now is a 2015 base, which I think is this, an extended basing formation that held up a new higher low. Then we had this accumulation phase, and in reality, we could be very similar to right here, 2002 or 2003, where we had this washout pattern before we start to move higher. So now we're going to come back out over here, and I'm going to spread this out to show you the 2015 base. Here's our base. It rallied up. Then it moved into this consolidation, and I'll just draw them like this. Consolidation phase. Then we rallied higher to this peak. Now we've seen this extended consolidation, an attempt at a new peak over here, which we did. We got quite a bit higher and then stalled out. And like I said, if we go back to the 2001, 2, 3 time frame, I get my chart to cooperate. Where we're at with this, ladies and gentlemen, is really kind of like right here. We're right in this area. We've seen this peak. We have this extended basing. Now we're right in this area. So where we're at with gold is pretty much right here, and I will readjust that. We're really kind of in this area. And what's happening in this area is we're basing, consolidating. We've had this big flush out. We're basing, consolidating in this area, building a base of momentum before we start this big rally. So understand that the next phase, in my opinion, is a move to do highs from this basing area, possibly up 20 to 40%. Then we will likely base out in about a year and a half as potentially global markets restructure and enter into a contagion phase. Then we will a slight little pullback, and again we will start another major move up, which could be again another 70 to 80% higher. And then eventually we will enter into the parabolic phase, and that parabolic phase could send us from this area, from that pullback up possibly 200-300%. So if we take a look at this, we have a, let me try to do the math here, a 40%, 85%, and 230%. So we will come over here, drag this out of the way. From this basing level, shrink it all the way down. If we just imagine from this basing level, a 40% rally would put us at 2,400, and then an 85% rally would put us at almost 4,000, and then a 230% rally from some basing level. Can't even get there. A 230% rally, if it were to happen, would put us at about 11,000 on gold. So that's really where the opportunity in gold is, and that's why the opportunity right now for you to make a dynamic change in how you're thinking about things can actually play out. This is, again, I want to point out that gold and silver are probably one of the best investments right now, simply because the Fed has pumped a ton of money into the economy. That money has to get settled and repositioned into what I call capital function, and it's going to take quite a bit of time as global markets deal with this credit crisis and debt crisis they're functioning through right now. I'm thinking the next 5 to 7 years could push us right into this type of a mode. Now, I may have drawn it out a little too far, 2024, 2028. No, actually, I drew it out quite well. So the real cycle end date is right here, 2028, 2029. And this is where I think we're at. We're going to have a move up to 2,400, 2,500, then a stall, then a move up to 4,000, 4,100, maybe more, then a stall, then a move to 11,000. And the way it would look for silver is very, very similar. Let's take a look here real quick. So we take a look at the same time frame from roughly this area. So we have from this basing area up to here. %100, and then stalled down into this area, and then 100%, and then stalled, and then a 463%. Okay, now comes the fun part. We'll shrink this all down. Drag this over here. We go 100% from this low, puts us at 36. And then we pick a moderate retracement area, go another 100%, puts us at 58. And then we pick a fairly deeper retracement and go up 460%, which I can't even do. $460%. Let's see, I'm 480, 460. Puts us at $250 silver. If we get the same setup. Now remember, this was the global financial crisis. This was the flight to safety. Central banks resetting everything and trying to save everything. Could we get to that before this point here, this major inflection point? I'll draw a vertical line highlighting this major inflection point. Quite honestly, I think we can. I think gold and silver can do this. If not, the 150, 160 area looks very solid. But I think we're very early on in this base. And I think that, like I said, everybody's discounting gold and silver. I think that we're going to have a little bit of a move in the market still, stock market. But I think we're very early on in this gold and silver trend. And what I want to highlight is this early excuse me, this 93 to 2003 basing and bottoming. In my opinion, we are right here. This was the base in 2015. This was our peak. Our stalling, stagnation, and now we're right in this area, basing after attempting new highs, and I think we're going to apex out. I think we formed our major bottom, we've had our washout low, and now we start the big move higher. So this move here in silver potentially could be 100%, but remember, as we move forward, look at how this continued to move all the way up to this level. So we moved all the way up through, and let me try that again so you can see. So we're right here. We have this move up to this peak coming next. Then we have some stalling, flagging, maybe a bit of rotation. Then we have another move up. Then this was the global financial crisis, and we could see a huge pullback. And this will, obviously, we'll try to pull out before this happens, but long term, look at what happens. From here to here, ladies and gentlemen, see, I got it. From where I think we're at up to here is a 577%, 580% rally attempt potential for silver. That would put it very, very easily up into the $160 to $200 range. Okay, So be aware, we got a lot of time. We've got 6 or 7 years to navigate this and really pay attention. So please, as you're doing me a favor, please take a look at my website at ment.com. Pay attention to what I'm doing. Follow me. I'm giving away my research. There's a lot of tools out there. It's completely free. Follow me on Twitter. Follow me on YouTube. Post your comments. I'm going to start some webinars in the next, this month, August, about live trading and automated trading. It may be hard for you to see here, but if I come back over here, these are automated trading systems that I've been developing and testing. You can see how they did last week. I reset these every week to test them and make sure they're working efficiently. The short-term model made $770 on the MNQ, the micro Nasdaq. The long-term trend-following model made $1,300. The accuracy of these systems are about 60 or 70% on average for the trade. Sometimes rotation can get a little dangerous. But generally, ladies and gentlemen, I'm going to start focusing you on automated trading solutions and how they work, because that's really my forte, as well as market research. But I really want you to get the most out of this. So we'll discuss this in the webinars. Join me in the webinars. We'll cover everything that I'm doing and how you can get the most out of my services. All right, that's it for now. Thank you very much.